dive right into it. This content is for informational purposes only. You should not construe any such information or other material as legal, tax, investment, financial, or other advice. Nothing contained on here constitutes a solicitation, recommendation, endorsement, or offer by Draper, Goren, Holm, or any other third-party service provider to buy or sell any securities or other financial instruments whatsoever. And you can catch the recording of this Blockchain and Booze on Blockchain Radio, our gracious media partner, and on Draper, Goren, Holm's YouTube channel. And our exciting topic today is all about venture investing, and more particularly, how do VCs generate value beyond their check? Because every fund can cut money, every fund has money, but how do they provide additional value to the portfolio companies and to other startups that they're trying to attract and invest in? So without further ado, I want to kind of give our speakers the stage to introduce themselves, as well as with what they're drinking, even though I feel like we're keeping it PG today for whatever reason. But Alon, really quick, give a brief about yourself and Draper, Goren, Holm, and all that you do. And then we can go to Matthew and then Soona.
All right, thank you, Adam. Usually thank you for having me, but it's weird.
It's weird. You know what? It wasn't weird when you were on here regularly, but now that you've left me alone as a lone soldier, then we have to welcome you properly.
I do feel like, though, it's weird because I also, like, the ones that I haven't been on screen, I've tuned into most of them, either running around on my phone or sitting on my laptop here at home. So I felt like I was a part of them anyway. But everyone, I'm Alon Goren. I'm one of the founders of Draper, Goren, Holm. We're an early stage blockchain venture fund, but before we had a fund, we were just a venture studio where we would actually do a lot of deals just right off our own balance sheet. We try to be the first check into companies and help them grow. And one of the things and one of the ways we got companies and found companies that we loved and joined was participating in the community and being a part of the community. So we do LA Blockchain Summit every year in Los Angeles, and we do a bunch of random other events throughout the year. And since quarantine, for about 9 months now, we've been doing these blockchain and booze events every Tuesday night. And like Adam said, he's kind of taken over the hosting role and been the one really running them and doing them. So thanks for having me.
Oh, well, it's great to be here. And I'm looking at your participant list, and it's an amazing list of people. And I'm surprised how many I know. I can see one person I worked with, A.T. Carney, back in the early 90s. Michelle, it's great to see you there. And a number of our LPs, and also quite a few of the VCs that are featured in our book are actually here in the participant group. And they should be on the other side. They should be the ones giving this speech and this talk because they know so much. But anyhow, it's great to be here. I got to know the Draper Goren folks a few years back. I've been collaborating with the Draper Network for quite a while at Keiretsu, where I'm one of the partners at Keiretsu Capital, and also through Link2. But I think I'm here primarily because I'm a blockchain investor. Blockchain Co-Investors is the leading fund of fund in the blockchain space, and we also run a co-investment program. So for full disclosure, we are investors in both DGH and also in Volt, whereas Soona is the GP, and we're very excited by that. Our goal is to invest in as many blockchain companies globally as possible through the VCs we back. And right now we're investors in about 250 blockchain companies, about 20 unicorns, and we're always very excited by anything that talks about digital monies, digital assets, and how the world's going to be different in the future. And so I'm pleased to be here. Thank you both very much for hosting. And I'm in particular very pleased that I was able to convince Soona to join as well. Soona is one of the latest funds that we backed, Volt, based in New York. And I think she has a lot to bring to the party, including a lot of access to some very interesting projects and companies. So I'm going to, I guess, just hand over to Soona.
I appreciate that so much, Matthew. It's been such a pleasure to work with you. And yes, I am currently in New York, like Matthew said, though when it's not COVID and we aren't in the middle of a pandemic, we're typically based in San Francisco. And we, at a very high level, are a venture firm that in a line is focused on investing in companies or helping crypto cross the chasm. And so we're looking at user applications that have the crypto part, I mean, essentially be invisible, because the end user solution is so important that it's not necessarily a loyalty to a certain protocol that incentivizes people to use the solution. So similar to how all of us aren't on Remo right now because we are active loyalists to HTTPS or TCP/IP or any other protocol that's charging the internet. We all simply want to be on a remote call right now, and the best solution for us is Remo. We similarly think the best crypto products aren't going to have adherence and users because they use a specific coin, but because the service is just that good. I've been a mentor at the Andreessen Horowitz Crypto Startup School and have seen a great variety of projects in Bitcoin, DeFi, which I'm sure we'll all jump into and talk about, but I'm really excited to be investing in this space now. The quality of founders that we have this cycle are the best that we've seen yet. And we've seen a lot more adoption. I think it's only going up from here.
Cool, and I guess I'll throw the first question at you, Soona, because you kicked off the last introduction. You particularly have a very unique background from Michigan, working right out of school with a startup, and then pivoting into starting this thing called Token Daily that really got you into the venture capital route, right? And you kind of started as a non-traditional investor. You created this newsletter. Kind of walk us through that process. And how you went from creating, I guess, like we call it, because we had a very similar story at Draper, Goren, Holm, creating more of a media side that generated value and that attracted people. So talk to me through about creating that newsletter and how that's kind of transitioned into you becoming an investor.
Sure thing. Yeah, there are many different ways to break into VC, and ultimately it comes down to having a competitive advantage that other funds or investors don't have. So to start, I'm an engineer turned investor. I got into Bitcoin back when I was in college at the University of Michigan, like you said, School of Engineering. All of us spent way too much time on Reddit, and the two predominant coins at the time were Dogecoin and Bitcoin. And the conversations around them was whether or not the government would even let these cryptocurrencies, quote unquote, happen. And I thought it was too early to start a professional career in the crypto space at the time. So I actually joined a startup, which was Elation. It's a data catalog that's really similar to a blockchain because it gives you insight into lineage of data. I was the 20th hire there. We closed our Series A, which was led by Andreessen Horowitz and Data Collective. We scaled it out to over 200 employees. We landed multi-million-dollar deals with like Pfizer, GoDaddy, Hilton Hotel, and other companies. And we just closed our Series C, which was co-led by Salesforce and Sapphire Venture in early 2019. While I was at Elation, I was the resident crypto expert. So I was showing people how to get set up with their wallets, which industry leaders they should be following in the space, what projects were cool. And at the time, it was only really CoinDesk, ways of Reddit or Twitter that gave anyone real information. And it was pretty tough to navigate and learn what was up from down, left from right. So I wanted to start a newsletter to be a source of truth, to help people that weren't in Silicon Valley navigate this new industry and really feel like they're part of the bleeding edge. And we spent $0 on marketing, and it grew like wildfire. So we had over 20,000 readers. We read in over 50 countries. And soon enough, founders were proactively coming to us to be featured in the newsletter. So like Lolly launched with us, a project called Compound launched with us, and users were giving us feedback on what they liked about the products. We were helping recruit talent to these companies. Like Lightning Labs, its head of operations, came in through Token Daily. And at that point, I was like, okay, we're doing what great VCs are supposed to be doing anyway. So we're helping place talent. We're sourcing these deals early and helping the founders in the earliest stages. And so now we're just doing what we were doing anyway through Token Daily, but doing it through a formal investment vehicle known as Volt Capital.
That's super cool because I feel like there's a stigma in VC. Okay, you have to go through the MBA route at an Ivy League. Okay, and then from there you have to break into investment banking and learn the IB side of things or the consulting side of things. Which Matthew, you kind of went down that route from Stanford and jumping into McKinsey and whatnot. But and Alon, you can speak on this too because you started the first Crypto Invest Summit, and you and Soona took it from a perspective of generating value, creating a platform that just so happened to lead to deal flow, right? Which is a very unconventional, from my point of view at least. You typically hear the more traditional route of people kind of going down that original path that I spoke upon. Alon, jump in really quick.
I think Matthew will probably be able to give us a ton of different stories.
Right.
He's literally written books on it now. But the I don't know if there's a tradition. If you step back, we sort of all went the traditional route. It's just, you had to build a network, you had to build some value. And sometimes building a network means hanging out with those people at Stanford, and sometimes building a network means locking yourself in a room with a bunch of crypto nerds. But at the end of the day, you kind of get the same thing, which is network. And usually the biggest value a VC can bring, whether it's so they can raise money for themselves or help their portfolio companies, is who else they bring to the table alongside them. And the biggest value is usually the people. And so, for us, it was definitely a non-traditional route, mostly because for me, it's because I was a bad student, not because I didn't necessarily want to. I'm just not that guy. And I did other things and created my own startup. And over time, we built a conference because we just loved a certain industry, and then sort of went backwards. We went we have this great conference. We have this incredibly valuable thing. We never wanted to do a conference and don't want to do a conference as a full-time job or do it to put money or to put food on the table. But how do we now use this to continue doing what we really, really love, which is, early stage startups? And we're obsessed with this new thing called Bitcoin. And how do we find the coolest people in the Bitcoin space and invest in their companies? And we just started doing it by ourselves randomly. I joked the other day with Joseph, we would have never called it Goren Holm Ventures in the first iteration if we knew anybody would publicly see the name. We just thought we were naming LLC something that we were doing sort of off of our own, we were just, sorry, I'm trying to not look at the chat because my ADD is just going wild. We would have never named it that, but it was an LLC where we did it on the side just for fun while we were running the conference. And then all of a sudden we realized we had something exciting, so we decided to scale it, and the rest is sort of history. But I don't know if there is nowadays a traditional route. I think the more untraditional you are, the more love you might get from certain people.
Sure. I'll tell you, from my point of view, and I'm a recent grad, and to get into VC, to get into any high-level investment firm to begin with, you usually need to have some type of consultancy background, some type of IB background to even be seen as credible as an analyst, for example, right? And Matthew, maybe you could talk us through more of that route because you went to Stanford, you did your MBA over there, you went and worked at McKinsey, you worked in big corporate America. Talk us through more of that route.
Well, I think it is true. So, 20 years ago, the first angel group was founded, which was Band of Angels, and Kretsu was founded about a year later. And I think the reason why those angel groups and networks, and later on incubators, accelerators, and investment networks like the Draper network, the reason why they began to get stood up and then they grew their membership and then they pulled ahead is because early stage investing is about as difficult as anything you can try and do. If you're an entrepreneur, you're dealing with new technologies that are not really well understood. You're trying to figure out how to apply them to real use cases, some of which may be existing, and you're trying to move them across to some new set of technologies. But oftentimes you're trying to establish new to the world use cases, which requires enormous vision and an awful lot of tough experimentation. And then you're trying to launch these things into the face of fierce opposition from established companies and industries and product providers who don't want you to succeed, and often regulation gets in the way as well. So for an entrepreneur, it's hard, but for an investor, it's even harder, because we have to deal with all of those same issues through the lens of you. We have to look at your business plan and what you're trying to accomplish, and try and figure out if it can actually be successful before we trust it enough to invest our own money in it. But in addition, we have a whole bunch of other due diligence issues around you and your corporate structure and your team and your project and the token and the white paper and all these other things. Well, the best way to attack that complexity is as a team, not as an individual. And I think that's what I learned. I had been the head of marketing and strategy worldwide for Gap after my first career as a consultant. I thought I was going to be a great angel investor, and I tried to do it by myself, and I understood it pretty quickly that I couldn't. I couldn't do it. I didn't know how to do IP assessments. I couldn't do deep technology due diligence. I understood markets and customers and products and services and pricing and marketing, but I was incomplete when it came to doing early stage tech investing. So I joined an angel group, Band of Angels, then Keiretsu, and later on, even at Blockchain Co-Investors, we're absolutely a network-based entity. We're LPs in 20 VCs, and we have about right now about 350 investors in our group, and we try and make smart decisions by leveraging the capabilities and the diversity of all of the people involved. So it's a very long answer, but if you're beginning, the first thing I would say is seek out other similarly situated, like-minded people and collaborate and learn from them. And then the other thing that's sort of in the background, be very clear on who's selling and who's buying, because especially in the crypto world, sometimes people hide their vested interests and they don't always let you know where they're coming from. And you want to be making decisions with similarly situated people, so you're all on the same side of the table. And I think we learned a lot about the risks of that not being the case in the ICO boom and bust. And I think it just sort of reinforced for those of us that have been VCs and angels for 20 and more years that unfortunately, you've got to flush out the vested interests early in any conversation. So I probably said enough. Join a team, find your fellow investors and work alongside them. That's probably the best advice.
Yeah, and Soona, I want to redirect this to you. When you were building Token Daily, one, is it still a vehicle for Volt Capital to push companies to discover new companies? You guys still use that as a value add?
Yeah, so our community pipeline, which is predominantly Token Daily, and also a community called Defy Alliance, which we co-launched alongside TD Ameritrade, Jump Trading, Cumberland DRW, CMT Digital, and others, are the way that we see deals early on and are able to track founders over time. And that the ability to source that way is really important because, one, not only are you seeing the development of the founder over time, community members themselves also are able to interact with and learn about the founder. So it makes diligence easier because you're able to get other people in the community really giving feedback on what it's been like to work with that founder. And it's also a way to see and find out who's building things early on, which is why, you know, we've had guys from USB invest in us, some of the managing partners at Founders Fund invest in us, because the community pipeline is what allows you to see things upstream and then send them to larger firms downstream to then, you know, raise Series A, B, and onwards.
Got you. And Alon, when you and Joseph were kind of starting out with Crypto Invest Summit and you were building out this conference, I know you keep reiterating that you guys were obsessed with the community and you wanted to meet more people in the community. But was there some form of like strategy down the line that motivated you to create a certain sector and a certain strategy with rolling out the conference for you to meet new companies, or was it a pure conference play?
Honestly, at the beginning, I wish I could say we had like a clear-cut strategy, but we both had businesses in the crowdfunding space many years ago. Like, you know, I started that crowdfunding as 2008. And later, towards the end of that business, you know, I don't know, I think around 2015 or so, meeting Joseph and seeing that he had a business in the space, we just had a need for a specific type of conference that our customers and the people we worked with in the crowdfunding space really needed. There was no conference in that space at all that was actually catered towards the two most important people in that industry. There was no conference for the startups that were raising money and the investors investing in them. Every single crowdfunding conference was for the service providers of that industry. So we go to Vegas to the biggest crowdfunding conference in the world, and there would be 500 people there. Then you'd go to Orlando to the next biggest one. There'd be 400 of the 500 people you hung out with in Vegas were in Orlando. And Joseph and I would like laugh, and we'd be like, why are we in Orlando in some random conference hotel to grab a beer together when we could be having a beer together in Santa Monica, for one, because we both live in Southern California and we're both near there. And then two, like, what's the point of these conferences? When I would see one of our customers at the conference, I'd be mad at them. I'd be like, you already have a lawyer, you already have an accountant, and you already have a platform. You have a business already. Why are you here? There's no startups here for your website, and there's no investors for those startups. You have no business being here. Go find those investors. Go find those companies. And at a certain point, you know, Joseph and I were like, we just need to do this ourselves. So we built the crowdfunding conference, and that had a very specific, you know, goal from the beginning. And we both had businesses that were benefiting from it. But after a couple of years of running that conference and sort of getting full-time sucked into the blockchain space, we both were kind of like, why are we doing a crowdfunding conference? We're not really in this business anymore. Like, our friends are here and stuff. It's interesting. It's a great conference we created, but we decided let's shift it completely towards the crypto industry. We rebranded it to Crypto Invest Summit towards the end of 2016, early 2017, right before the chaos and craziness. And then we kind of were standing there. Like, I was working for a fund at the time, so it was very self-serving. I helped Wavemaker at that point create their crypto fund, but their crypto fund wasn't what I was super passionate about, because they were trading tokens and doing banking style transactions, right? And that's not my thing. You know me, I like working with early stage startups, and I sort of shy away from any deal where somebody comes to me like, buy this token today, it's gonna be worth 3x tomorrow. If I don't know the founder and can't look at them in the eyes, I just can't get excited about those kind of things. So when I decided to go full-time with Joseph doing these deals and stuff like that, that's when we took the conference and went like, okay, let's be a little bit selfish about this. We have this awesome conference that we hang out with these awesome people that we love. How are we going to find the best companies here? How are we going to, you know, find the best investors here to work with? And so we started doing very specific things, like we'd have a pitch stage, and that pitch stage, some people would pay to be on it. It was like always the cheapest and lowest level of sponsorship. But 90% of the people we put on this pitch stage, it was kind of like attendees of the conference. Pretty much anyone could get anywhere for free if they asked nicely. And the whole point of that for us, I'm sorry if you could hear my kids screaming in the other room.
We can.
In the background. So you know, we sort of used that as our biggest funnel. You know, we would go super wide. We watch 80 companies pitch on this stage. We would meet all the sponsors. We'd meet all the attendees. And then we would, you know, sit afterwards and go like, who was the most impressive people we met at the conference? You know, one year it was David Blesnak from Total, who ended up being one of our portfolio companies. One year it was John and Joe from Lunar Crush. Like, you know, there's you know, certain people we would meet and just be like, we want to be on their team. We'll do anything we can to work with them. And there's some people that were really, really disappointing too. And we got to use the conference as a good way of doing due diligence. And so we started shaping the conference towards our goals and agendas. You know, like, we as a fund have to fundraise, so we'd have private investor dinners in the evenings, or use those to introduce them to our portfolio companies. We started using this platform. VC funds like to use the term platform, and some of them create it by doing what Soona did or create it by doing what we did. And then some of them raise a lot of money and then use that money to hire, guys like you, Adam, to create events for them and do things like that. So we sort of went value first in terms of that kind of thing, in terms of platform, and other people do it the other way. There's no right or wrong way. It's just that's what we did. Once we realized where our clear and most important goal is, because we knew the conference wasn't there to make money. The conference was there to build an industry and build a community, especially when we started it before we even thought there was ever going to be like a super blockchain community, Like in terms of like a monetary value. We did it because we were like, we have the convention center already booked for some crowdfunding conference we don't really want to do anymore. Let's hang out with these other people that we really want to hang out with.
So Matthew, obviously there's a common theme between these two funds, between Soona's fund, between Alon's fund. Is value add in these like additional platforms something you look at before dumping money and investing in these founders, these investors, or consideration? Because obviously it's a common theme. So talk me more through your process in that.
Yes. So I've already sort of laid the foundation for that question, Adam. Thanks a lot for asking it. Obviously, this is the toughest thing that anyone can try and do. By the time you get to blockchain and distributed ledger, you're talking about attacking opportunities on a global scale. And it's really hard to create a startup from day one that is going to be trying to address a global opportunity or a global marketplace. So I think, and then let me add that most people that really, really understand emerging technologies, and in this case, distributed ledger and everything that goes with it, they tend to be engineers and technical by training and by mindset, which is good. But it means that they have a lot of blind spots. There's a lot of things they're probably not good at. And in order to stand up a global blockchain-based network or protocol or something built on top of it, like a Coinbase or a Circle or a Kraken or something, there's a lot of other skill sets needed. And so I think that you need, as an entrepreneur in this space especially, to seek out a set of investors that bring value added and not just capital. And firms that lead with that thought tend to be very hands-on, very value-added, very collaborative. They're trying to help and they're trying to work together with you. And that's what we really saw in both DGH and in Volt. So, we're very excited to be investors in both. I also offered to be an advisor to the blockchain venture studio that Joseph and Alon and the team, Adam, and you have created. But the reason is that I don't think a blockchain startup or a crypto startup can be successful unless it gets a very large network of people to help. And those people have to have diverse backgrounds and interests. So I do like the tokenized projects where you're using a token and some sort of an airdrop or something to motivate a network of people. But it isn't just good enough to get, a lot of people helping a little bit. You need a few people who are going to help a lot. And typically it's your investors or the people that are really motivated by what you're doing that are really going to spend serious time. And so we, in early stage in particular, we look for VCs who are very participative, collaborative, and value added. And that's also true in the angel networks as well. And so what's the other side of that coin? I would say beware taking a lot of money from financial investors who bring no value added and simply want to make a lot of money. Those people are not going to be there when you need help. They're simply going to look over your shoulder and tell you what you're doing. You need people who want to build your business with you. And I think Volt and DGH are good examples of those types of firms.
Yeah, and in Volt, again, Soona, you talked about Volt came out of Token Daily. What other resources have you guys birthed from that? So Token Daily birthed Volt. What kind of grew? What other value adds generated and grew from Token Daily brand?
Yeah, that's a great question. So we also started the Defy Alliance, which actually was something I was going to add on to Matthew's great and thorough response. is that the type of a value add an investor is going to give a company also slightly differs in terms based on that help, based on the type of crypto project being developed. So if you are looking at DeFi projects or typically crypto native projects, the two biggest buckets that we see companies need help with is one, sourcing and attracting liquidity from market makers, because DeFi itself and volume in general is a cold start problem, because traders want to go where there's volume, and you need volume to begin to attract people to come trade. So in order to kind of circumvent that problem, or to actually get the activation energy to get started on your project, you need a market maker, you need institutions that are going to take that leap of faith. And though they may not see anything short term, believe that long term, this is something that will pay dividends. And the second part is regulatory guidance, specifically given where we are in the market right now. And those are the two main places to add value for crypto native projects, is like attracting liquidity, regulatory guidance. And then for more traditional equity types of companies that are building picks and shovels in the crypto space, they have cash flows that can be valued like vanilla equity companies. They have these same problems that most startups do in general tech sectors, right? So they need to, and they need partnerships and customers. And that's not to say that the crypto native projects don't have those problems as well, but they also are waiting heavily on liquidity and regulatory guidance. So one way that we've been able to check box all of the above is through this niche community. So there's like the Token Daily umbrella, but we also have something specific to DeFi called the Defy Alliance. And that is, like I mentioned, an initiative that we launched and really had organic demand and pull, because we kept seeing these projects like Synthetics, like Aave, Teller, and other projects that early on wanted to get the right market makers, get in front of the right market makers, get the right regulatory guidance, attract the right talent, and doing this in a more formal way where there are cohorts of great DeFi projects that we could curate and then put in front of Jump Trading or Three Arrows Capital and other firms was really valuable. And I'd say that's another way that we've been able to help our companies really get from 0 to 1.
Awesome. And Alon, kind of walk us through, so Crypto Invest Summit, now LA Blockchain Summit, was the first value add vehicle. What came out of that? What else are you guys using, or what else are we using? Talk more about that to help our portcos to attract new investments and whatnot.
So, very quickly, we sort of looked at, what we do with our conferences as a value add, because people were coming to us and hitting us up for, in the 2017 craziness, when things started to really heat up, every random project and their brother was sending us a note saying, we'll give you a bazillion tokens to make us a sponsor of the conference. And we never once took tokens for a sponsorship like that, because we just didn't believe in those projects. We had to like a project first. We actually got in a little bit of trouble with certain groups of people where we wouldn't even take some people's money to sponsor the conference because we didn't want to be associated with them. And so, that was a sort of, issue that we had with the space. But we learned very quickly, like, people wanted this and people needed this, but we wanted to only do it with the projects that made sense. So for us, we use that as part of our sort of superpower. And what a lot of people don't know is we did hire, like not marketing firms, but more like contracting firms that work on event production to actually staff the event and do that kind of stuff. But until we hired you in March, so less than a year ago, Joseph and I were the only employees, only full-time people doing LA Blockchain Summit. We got to the point where we have 5,000 person crypto conferences with 2 people. And the way we did that was by automating the shit out of everything, by figuring out how to sell sponsorships in an automated fashion, figure out how to market in an automated fashion, figure out how to get press and media partners to fill up the room. And so we realized that when we did bring on a portfolio company, our biggest value add was figuring out how they could use those superpowers to grow their companies. And some of the things that we do, for example, we pay for a marketing database so that you could reach reporters at different news outlets and things like that. Traditionally, PR firms pay for that, but we thought we could do everything better ourselves, so we started using things like that, and it cost us a lot of money, but it was really valuable for the conference. Now we use that same database to share news from our portfolio. Every month you send that note to our portfolio companies asking what's new, what's going on, how can we help, and they tell us that they're about to make some announcement. We make sure that the press release gets into the right hands, not just the media partners, the crypto media for the conference, but if they're doing a deal for security tokens in France, we'll make sure that the people who write about business news in France get that also. And we do weird things like that that don't really make sense that the average VC firm or group does, but we just take the things we think we do best and we do that. Like Soona has the DeFi segment. We also do the we do stuff like that where we have our global DeFi summit once a year where it's like a 1-day event, or we had our security token summit we used to do and we're bringing back this year because of Onera and Symmetria and some of our portfolio companies, which by the way, Adam, I hope you get everyone who participates in the Defy Alliance to DeFi summit this year too.
Oh yeah, we got to do that. I'll connect with Soona afterwards. I want to jump into the QA section because the audience members who are tuning in live have put some pretty interesting questions, and Soona and Matthew, I already see you guys have replied to some, so that's great.
Yeah.
But this one comes from Thomas William Pillsworth.
Yes.
So why invest so early on? There are companies who didn't get early funding and establish their vision and now need money but aren't considered a startup. So I don't know. I want to hear from everyone. We can start with Matthew, go to Soona, and then Alon.
Okay, great. So yeah, I was just reading the question too, and I actually think there's 2 questions in this question. The first one is, why do we as investors invest early? And the second is, what happens if you are a company and you're past the early funding stage and you need additional funding? For us as investors, all of the statistics demonstrate that the early stage venture return is much, much higher than the mid-stage or the late-stage return. To give you a sense of that, Cambridge Associates talks about, in fact, over 25 years, they talk about a 60% return net to their LPs in the early stage, dropping to about a 15 or 16% in the mid-stage, and all the way down to 11% in the late stage. Now, a late 11% return is roughly the same as you get in the public markets over that same 25-year time frame in the S&P 500 and NASDAQ over the long haul. Last year was a special case. So if you are trying to maximize return for your investors, you want to go in early. And even though the risk is higher, the expected return of the asset class is much, much higher. Now, in practice, most large investors are trying to allocate a lot of capital. And so for them, they will put most of their capital into the late stage, like SoftBank putting in $100 billion, because they don't really care about maximizing the return. They care about allocating the greatest amount of capital. So that's sort of why we are early stage investors. We may not have the most capital, but we do get the highest return. And I think that's true in blockchain too. You look at the people that backed the tokenized assets, the Filecoins and the Polkadots and so on, the Ethereums, and obviously the Bitcoins for that matter, and they got the disproportionate share of the value created, even if it was a distributed network. The people that began still got a disproportionate share of the value. Now, the second question, which I'll quickly answer, is what happens if you are a mid-stage company and you haven't already raised capital and you want to raise capital? Well, the challenge you have is presumably you're going to put quite a large value on your shares, and therefore the type of investor who's going to back you is going to be someone who's more likely to be comfortable with a lower return. And those people are out there. Family offices, hedge funds, late stage VCs, they are out there, private equity firms, of course, but they're a different group of people, and they tend to be more financially driven, and they're going to analyze you in more of a net present value sort of a way, rather than in a vision, what are you trying to build sort of a way, which early stage investors tend to, they tend to see make their investment decisions more around what's your vision and what are you going to do to change the world in a positive way, whereas late stage investors, it's much more around what return are you going to deliver. But anyhow, that's sort of the way I'd answer the question. Soona, what's your view?
Yeah, I completely agree with regards to just the value capture that you can make in a really frontier, bleeding edge kind of market, specifically when the delta for innovative ideas, founders coming into the space is so high. I mean, right now is where the benchmarks of this new frontier are being built, the Sequoias. I was just reading E-Boys, and it is a book on the genesis of how Benchmark came to be and the multi-billion-dollar bets. They ended up multi-billion-dollar value generated from their investments in eBay, in Webvan, and others. And there are so many analogies that can be drawn between the crypto space and what teams and in the investment landscape was like in the early internet days as well. So highly recommend that read for folks that are listening to us today. It's called E-Boys.
Cool.
Yeah, I'll just iterate because I think they gave really, really excellent answers. I think I have sort of two reasons for being super early stage, and we're like extreme on the early stage side. Is one, I've done a ton of research on what Matthew discussed and what Soona was talking about, sort of the earliest stage venture funds from a very practical standpoint do, if you're in the top quartile, top decile, generate the highest returns. And there's statistics and tons of studies that show casting a very large net in terms of building a large portfolio. It doesn't mean being stupid and doing spray and pray and stuff like that, terms people use, but having a large portfolio and then being able to exercise optionality as the companies grow has the highest percentage of returns, because as one, that large net of companies are very, very risky, right? Because you're at the earliest stage. With us, it's two founders and ideas sometimes. And that's the riskiest time to invest, but you're also investing the smallest amount of money at that time and getting a bigger portion of the company. And then as they grow, you have the option to lead their future rounds or participate in their future rounds and to build your amount of ownership in those companies as they grow and keep continuing to capture that value. And then the second reason I do it is because it's really the only, or probably the biggest stage in which I feel like I can help. I'm an early stage techie. I can do a little bit of programming and some technical stuff, and I want to goof around with your product and help you. And it's really only at that super early stage where I'll be able to do that. So for me, that's the most fun stage too. And so that's why we do it.
Cool. And just to continue with the QA section, and all of you touched upon this, but maybe we can take this next question from Brent in a different direction. So, do you venture investors provide or refer talent as well as capital to jumpstart attractive ideas? And maybe we can take this more from, if someone comes to an idea, right, they don't have a team, do you guys actually jump in and help build the team for them? Is that how hands-on you guys get and add more value? And we could, I'm like throwing it in the air. Whoever wants to jump in can jump in.
All right, well,
I can.
Yeah, so truthfully depends on the founder. So some founders, if it's a first-time company they're founding, or they are doing it in a new space and they've had an exit in another sector and are new to crypto but have this amazing idea that they're building out in the skill set and just need to know the community, you as an investor, especially in early stage, need to be willing to roll up your sleeves, source the talent that they need. They should also, to an extent, be able to do that as well, since they are the founders, and that is a key skill is to build up the team. But of course, you want them to be able to also lean on you as a value-add investor. Some founders are already come from Coinbase alumni or Gemini alum, and they already know the people they want to hire. They've already talked to them. They're doing trial periods right now, and so they're kind of like, I know exactly what I'm doing. Get out of my way. And then and in that case, when they want you to be more hands off, you need to be able to calibrate based on the founder. So it truthfully isn't a one size fits all, and comes down to the company and the team that's founding it.
Yeah. The only thing I'd add to what Soona said is it also changes over time. So right at the beginning, you can think of it as what's the minimum viable team to get this stage of the project's life completed. And you as a founder need to make sure that you do have that minimum viable team. And if you approach investors and you don't have it, it's going to be very hard to get funded. We're not really in the business of creating the minimum viable team. We're certainly in the business of bringing additional resources to bear over time. So, the classic example, of course, is the Winklevi twins, who had a great idea, but they didn't have the skills to do it. And they had to go and get Zuckerberg to build it for themselves. And we know how that finished up. You want the minimum viable team at the outset to include people that can build the vertical slice or the prototype, or could stand up the pre-mainnet version of the technology in the case of a distributed project. So I would say, yes, good value-added angels and VCs bring other people to make the team better. But you as a founder have to look at yourself and say, what am I able to do and what aren't I able to do? And which things are required in this stage of this project's life? And then you've got to find the second and the third and so on until you get to the minimum viable level. And at that time, I think you'll be able to progress through that phase of your project's life. But all of these projects are going to need more and more skill sets over time. And I think we already see that. And someone earlier on, maybe it was Alon, talked about the regulatory issues, or maybe it was Soona. If you're a fintech, and a lot of this is about digital monies and digital assets, if you're a blockchain fintech company, you've got to have regulatory expertise early, not late. It's too late later, so to speak.
Yeah, I just to double down on what Matthew just said. As investors, we can only amplify what the founders do. We can't, supplement it or really, be that co-founder. We can in certain weird situations, but the team has to be there. We can't, there can't be a hole before we invest. We want to, we can do our best work when you're executing, when you're doing things, and maybe guide you to the right place, introduce you to, the right maybe securities attorney, help you find other members of the team, or in our case, amplify the marketing and things like that. But it's the number one thing we can do is amplify your good work. And so, that's really important. And speaking to the original question, Adam, I even, because we're so early, we sometimes will make a bet or work with somebody because we really, really love this person. We think they're like the smartest person in the room about a certain subject. They're so passionate. But even this week, I made a suggestion to one of our portfolio companies that they might want to offer another founder in our own portfolio the opportunity to kind of come together and work on something, where the sum of their parts will be greater, right? And that's kind of weird, right? That's like almost saying give up on your idea, but I think that these people together can do something exciting. And at that super early stage, that might be something, they might decide to still go do their own thing, but I did make that suggestion. So you never really know. But once you start working with people at that early stage, for me, I know that if somebody doesn't get to the next level and get to the point where our fund could write a large check to them, I still want to know the next project they do. I still want them on my team. I wouldn't have made the investment or worked with them, from the beginning. So I think there's some interesting opportunities that can come from being involved. But I think Mathew is totally right. There has to be the minimum viable team to begin with. Right. And we just want to, for me, I just want to amplify it.
So actually, to follow on to that, because Alon, you touched upon this, would you not take an investment if you couldn't see what you could add to it? Like, you wouldn't cut a check if you know for a fact there's nothing I can add within my network other than just a check. And this applies to all of you guys, but I want to take it from Alon because you just brought this up.
We have a conversation every time we're thinking about working with a company about what are our next steps. We do, if the deal is done this moment, what are we going to do next? And if we don't know what we're going to do and we don't know what kind of value we're going to add, it doesn't make sense to do the deal for us at the venture studio stage.
Right.
We're not, inactive. Like we have to be active and we have to know we're going to sort of amplify it, add the value, and do that whole thing. And we've not done deals with people who we thought were really smart because we just didn't know how to help them. We didn't know how to add the value. And I won't lie, because the venture studio writes checks kind of like an accelerator. It wouldn't be fair to take that much equity from a company for the check we write if we can't add the value. We're a crappy investor if we do that. We're not good people, and it just doesn't make sense. I've met like really smart people doing like a blockchain medical type of startup or something like that, where we just don't know how we would help them because it's not our world at all. So I introduce them to people who are smarter than me in that particular industry, and that's what we do. So we definitely don't just write passive checks. Maybe the fund may do something like that in the future if we missed out on an early stage company. We know they don't really need our help anymore because they're already at the Series A or B or something like that. But we really have to feel like we're adding some value beyond just a check.
Soona, at Volt, would you guys just cut a check without seeing what additional value you guys can add? Or do you have to see the value add before you invest in a team?
So the great thing about having community be your competitive advantage is that there is no company in which that will not be valuable to them, because with a community, it's kind of a Swiss Army knife of sorts, because you are getting talent that can be hired to the company. And let's say talent isn't one of their problems. They're getting potential users and customers. And those are two really predominant things that all companies need in some way at some point in their lifespan. So and I don't mean this to be cocky at all, or to come off kind of in a way that seems like I'm generalizing, but it really is true that when you have a quality, vibrant community, there will always be a value add for a company, because companies are all about people, whether you're hiring them or whether you're serving them. And that's ultimately what it comes down to.
Got you. In Mathew.
Well, I think, Adam, let me answer the question from the angel perspective. For the entrepreneurs on this stream right now, the reality is your first money is going to come from angels, almost certainly. And I would say angels come in different flavors. We just wrote a book called The Intelligent Investor, Silicon Valley. You can find it everywhere, Alice and I. And in fact, some of the people featured in that book are on the line right now. I was just looking through. I thank them for being here. I won't call them out by name, but just to use them as examples. In the book, we ask 50 of the leading angels and VCs why they invest and how they invest and what they look for. And this topic of value added is written all over their responses. So one of the people who's here right now is one of the leading life sciences angels in the Bay Area, and she knows more about life sciences than anyone else I know. And I know that when she backs life sciences companies, she leans in and she provides a lot of value added. I also know that when she invests in blockchain companies, she brings the capital to me, and I invested on her behalf, because that's not an area she understands. Now, conversely, one of the other people that's on the line right now is a real financial services and markets and blockchain expert, and so she's not only backing blockchain companies. She's actually become CEO of one. So I think what you'll find amongst angels is almost all of them know that they're really good at something, and it may not be an industry. It could be that they're a lawyer or an accountant or a consultant who knew everything there was about go-to-market strategy, and that's their value added. And if they're giving you money, it's because they also want to help you succeed, and you'd be crazy not to ask them to bring their expertise as well. And I'd say actually that's a hallmark of a good entrepreneur. The good entrepreneurs incent and motivate talented people to bring their own talents to the party. And conversely, bad entrepreneurs think it's just about the money, and they think they can do it all themselves, and they can't. And so I don't think it's just a question of investors saying yes or no based upon expertise. It's good entrepreneurs seek out value-added money, and then they make it really hard for you not to help. Really.
So is that number, and I want to wrap it up and finish with this last question for everyone. So is that one thing you look for in a founder to see if they can spot the value add in you as an investor?
So let me just answer, Adam. No, it's more than that. And it's in the book, by the way, because we asked that question of all 50 people. Joseph Holm was one of the contributors as well. It's the great entrepreneurs are able to visualize a future and know the tailwinds of the environment around them are driving towards that future. They're passionate about making it happen. They know how to motivate a group of people or a network to drive in the same direction, and they know how to get things done. And they are collaborative motivators, and they know how to get people to do things. And they also, there's some other things, they don't take no for an answer, and keep on driving when other people give up. And I could keep on going, but those are sort of the hallmarks of a great entrepreneur, and it is in the book. 50 VCs and angels answered that question.
And it's a great book. We talked about it at LA Blockchain Summit as well. We had a really great panel with Tim, yourself, Matthew, and Joseph. And I'll link the book afterwards when we send our recap email so everyone can check it out. But Soona, at Volt Capital, I'm sure there's a laundry list of things that you guys look for before you decide to cut a check and invest in a founder. But what's that one thing? So if there's founders watching right now that are interested in applying to Volt Capital, what's that one thing you guys look for within a founder that you know, okay, this is legit, this is worth putting our time, effort, and money into?
Yeah, that's an excellent question. It's really hard to pick one thing, to isolate it into one thing, because there are very different flavors of entrepreneurs that are successful for very different reasons, and oftentimes can use what can be perceived as a flaw for some as a virtue or the reason that they succeed in other folks. So it's really hard to nail it down to one thing, but I would say a common thread that most successful entrepreneurs have outside of the usual things that you'd expect, like grit, resilience, listening to an inner voice and having that be their North Star. And this one's a little bit more unobvious, but it's the ability to clearly articulate an idea and the motivations and forces that go into their decision making. So that clarity of thinking is the thing that I think is a common thread for all successful entrepreneurs, because it's what guides them through a pivot if they need to. It's what guides them through making the right hires. It all stems from this clarity of understanding why you're making the decisions you're making and being able to articulate them to others as well.
Perfect. And Alon, I know it's hard again to bundle it up into one thing because there's a bunch of things we look for at Draper, Goren, Holm. But if you could say there's an overarching skill, thing, whatever it may be, that you look for in an early stage founder, what would it be?
I'll break the rules and say two. I think that what everyone
one.
Hey, I sign your paycheck, bro.
Yeah.
No, but the passion. Somebody that has to be so obsessed with something. They have to be crazy obsessed. But what Matthew was saying earlier about the not taking no for an answer and being persistent, being hungry, like being that person, there's nothing more important than that, because when you're an early stage startup founder, you're basically selling to, you know, potential hires and things like that, you know, why they should take a lower paycheck to work at your company and own some equity. Probably harder than you're even pitching to investors, because, you know, you're an early stage startup. You don't, you know, it doesn't come easy, and people kind of cringe at the word salesperson. But when you're a founder, you are selling to investors, you're selling to customers, you're selling to employees. You have to sell harder than anyone in the world. And if you're not obsessed with the product and selling it and persistent, you're just not going to succeed. And, you know, that's where maybe what Soona was saying, some people's, you know, flaws might be a virtue in the startup world. Sometimes being an aggressive salesperson doesn't rub certain people the right way, but is definitely, you know, people do it in different ways, but at the end of the day, getting what you need done, getting shit done, executing, you know, 90% of it from a CEO founder's, you know, role is selling. It's just is purely selling. Obviously there's the product, there's everything else, but if you can't get anyone to use it, can't get anyone to buy it, can't get anyone to build it, can't get anyone to invest in it, not going to happen. So that's, you know, where I get excited.
3 great answers from 3 great investors. Guys, thank you so much for being here. This was what? This was episode 42, session 42, whatever you want to call it, of Blockchain and Booze. Alon, Soona, Mathew, you guys were great. Thank you for your time. Before I let you guys go, really quick, plug yourselves, plug your companies. Where can we find you and learn more about what you're working on? So we'll go with Alon, Soona, and end with Mathew.
I've plugged enough. Go, Soona.
Okay.
Our website is volt.capital, and you can find me on Twitter. It's at Soona or later. We also have a newsletter, which is Token Daily newsletter /join-newsletter, to stay up to date regarding what we're seeing in the crypto space and projects that are launching.
Cool. And Mathew?
So if you're an investor, it's blockchaincoinvestors.com. And we also have an angel list syndicate with the same name. If you're an entrepreneur, right at the very beginning, we'd love to see you at Kretsu. And if you are a blockchain entrepreneur specifically, I'd refer you to the Blockchain Venture Studio that these guys here are operating. Because I think it's got a lot of value added to offer. And but, you know, lovely to be here, and it's great to see that so many people stayed so long, and hope you got some value.
Cool. And before we break off and end the session, I already see a few of you leaving. So whoever was about to exit the tab, just wait, okay? Right now, we're about to enter into my favorite part of Blockchain and Booze, the networking session, where all of you guys who are watching live, and if you are watching the YouTube live stream, make sure to join through the Remo link somewhere on the YouTube page. But basically, right now we're going to break through this whole entire presentation mode, and we're going to be distributed to these really colorful tables where each of us will be able to bounce from chair to chair and meet everyone that's joined live, and basically meet, network, and hang out with everyone over a drink. So before we go, make sure to have your cameras on, make sure to have your microphones on. Otherwise, you're going to be really, really confused. So mics on, cameras on. Let's do it, guys. We'll see you next week.
Thank you, Matthew. Thank you, Soona. I'm so happy you guys joined us today.